In 2024, State Farm stopped writing new homeowner insurance policies in California, not reduced coverage, not raised premiums, stopped entirely, then Allstate followed, then Farmers, then Tokyo Marine, then 7 more carriers in a single calendar year. What happened next was not a headline, it was a mathematical sequence. No insurance means no mortgage means no sale means no price discovery, and no price discovery means an entire real estate market begins to operate on assumption rather than reality. Right now, across Florida, California, Louisiana, and Texas, millions of homeowners are sitting on properties that the insurance industry has quietly declared uninsurable. Their Zillow estimates still show appreciation. Their county assessments still show taxable value. Their bank still holds a mortgage against that value. But the one institution that is required by law to validate that value, the insurer, has already left the building. This is not a housing crash driven by interest rates or unemployment. It is something structurally different and far more permanent. It is the withdrawal of the financial infrastructure that makes home ownership legally and economically possible. And the American real estate market has no protocol for what happens next, because this has never happened before at this scale. The insurance industry does not make emotional decisions. It makes actuarial ones. When a major carrier exits an entire state, it means their risk models have concluded that the expected losses exceed the premiums they are legally permitted to charge under state regulation. They are not being dramatic. They are being mathematical. And the math is now pointing to an uninsurable geography that is expanding every single year. According to data from the First Street Foundation, approximately 39 million properties across the United States are currently at substantial risk from climate-related perils, including flood, wildfire, and wind. That number is not a projection. It is a current assessment of existing exposure. Of those 39 million properties, a growing percentage exist in markets where private insurance has already retreated or is actively repricing to levels that make ownership economically irrational. The National Association of Insurance Commissioners reported that between 2018 and 2023, insurance companies paid out more in claims than they collected in premiums across the homeowner segment nationally. That is a structural underwriting loss that no amount of premium increases can permanently fix if the underlying risk continues to compound. When an industry stops making money on a product, it stops selling that product. That is not a conspiracy. That is capitalism responding to physics. The mechanics of what happens when insurance exits a market are precise, and they unfold in a specific sequence that most homeowners do not understand until they are inside it. Stage 1 is carrier withdrawal. The largest private insurers exit the voluntary market, either refusing to write new policies or declining to renew existing ones. Homeowners who lose their private coverage are forced into the state-run insurer of last resort. In California, that is the FAIR Plan. In Florida, it is Citizens Property Insurance Corporation. These residual market carriers were never designed to be the primary insurer for millions of properties. They were backstops for the uninsurable fringe. They are now becoming the default insurer for entire coastal counties. Stage 2 is premium shock. As the private market contracts, competition disappears. Citizens Property Insurance in Florida currently insures approximately 1.2 million policies, a number that has more than doubled in 4 years as private carriers fled. Without competitive pressure, premiums in these state-backed plans have risen dramatically. In parts of South Florida, annual homeowner insurance premiums have crossed $15,000, $20,000, and in some cases $30,000 per year on modest single-family homes. That is not a monthly number. That is the annual premium alone, before a single dollar of principal, interest, or property tax is paid. Stage 3 is mortgage lender response. Federal mortgage guidelines from Fannie Mae and Freddie Mac require that every property securing a conforming loan carry adequate insurance coverage. When insurance costs make coverage prohibitively expensive or unavailable, lenders begin to flag these properties as non-conforming collateral. A home that cannot be financed through the conventional mortgage market is effectively illiquid. It can only be purchased with cash, and cash buyers demand a discount to compensate for the risk they are absorbing without the protection of insurance. That discount is how property values begin to decompress in uninsurable markets. We have direct evidence of this valuation mechanism already operating in the United States. Louisiana provides the clearest case study. Following a series of catastrophic hurricane seasons, major carriers began exiting the state in 2021 and 2022. By 2023, 12 private insurance companies had been declared insolvent by Louisiana regulators, including several mid-sized carriers that had been operating in the state for decades. The result was not a slow drift in home prices. It was a sudden and measurable repricing. Data from the Louisiana Center for Insurance Research showed that in parishes where insurance availability declined most sharply, median home values fell at a rate 3 to 4 times faster than comparable parishes with stable insurance markets. The transmission mechanism was exactly as described. No private insurance meant forced reliance on Louisiana citizens, which raised premiums aggressively. Higher premiums pushed monthly housing costs above what the local income base could support. Mortgage demand collapsed, transaction volume fell, and with no buyers to establish a market price, valuations began drifting downward toward the level at which cash investors would accept the risk. That level was dramatically lower than what sellers expected and dramatically lower than what banks had lent against. Now apply that same sequence to Florida, which is not a peripheral housing market. Florida is the third largest state by population and has experienced one of the most aggressive real estate appreciation cycles in American history. Between 2020 and 2023, median home prices in South Florida rose over 50%. Institutional capital poured into the market. New development accelerated. Tens of thousands of new residents relocated from high-tax northern states, drawn by the combination of no state income tax, warm weather, and what appeared to be appreciating assets. But beneath this appreciation cycle, the insurance foundation was crumbling in real time. Citizens Property Insurance, the state's insurer of last resort, was warning regulators as early as 2022 that its reserve levels were insufficient to cover a major hurricane event. A report from the Insurance Information Institute in 2023 estimated that a single major hurricane making landfall near Tampa or Miami could generate insured losses exceeding $100 billion. Citizens at that time held reserves of approximately $14 billion. The gap between those two numbers is not a rounding error. It is a solvency event. And if Citizens becomes insolvent following a catastrophic storm, Florida law allows it to levy assessments on virtually every insurance policy in the state, including auto, commercial, and even policies from carriers not originally involved in homeowner coverage. This means that a hurricane hitting Tampa does not just destroy Tampa. It creates a statewide insurance surcharge that raises the cost of coverage for every property owner in Florida simultaneously, spreading the financial damage across the entire state economy. The insurance crisis does not stop at the property itself. It moves through the banking system via a mechanism that regulators have not fully stress-tested. Every mortgage held by an American bank against a property in an insurance-stressed market carries embedded collateral risk that is not being recognized in current loan valuations. Banks are required by regulation to maintain adequate collateral coverage for their mortgage portfolios. That collateral coverage is based on appraisals, which are based on comparable sales, and comparable sales are based on transaction volume. But in markets where insurance has retreated, transaction volume has collapsed because buyers cannot secure financing on properties with uncertain or excessively expensive insurance. When transaction volume collapses, the comparable sales data that supports appraisals begins to thin out. Appraisers, who are legally required to use market evidence, struggle to find recent transactions that justify existing valuations. This creates a frozen market where prices appear stable on paper simply because no one is transacting. But this stability is illusory. It is the stillness before the repricing, not evidence of underlying value. When a forced sale occurs, whether through foreclosure, estate sale, or financial distress, it reveals the gap between book value and market reality in a single data point that then infects every comparable property in the area. The Federal Reserve's financial stability reports have begun to acknowledge the intersection of climate risk and financial system stability, but the language remains cautious and the timeline vague. What the reports do not fully capture is the speed at which insurance availability can shift from adequate to catastrophically inadequate following a single major loss event. The California wildfire season of 2023 accelerated carrier withdrawals dramatically. Before the 2023 season, several major carriers had already reduced their California exposure. After the Lahaina, Hawaii fires demonstrated that even seemingly low-risk areas could experience catastrophic wildfire losses. The reevaluation of wildfire risk across the entire western United States caused another wave of underwriting restrictions. State Farm's decision to not renew approximately 72,000 California policies in 2023 was not the end of that process. It was an early inflection point in a much larger structural withdrawal. The California Fair Plan, which exists to cover properties the private market rejects, saw its total exposure grow to over $300 billion in 2024. That is a staggering concentration of catastrophic risk sitting in a state-backed entity that holds nowhere near adequate reserves to cover a large loss event. If a major earthquake or firestorm triggers losses against those $300 billion in policies, the California Fair Plan would require a state bailout that would restructure California's fiscal position for years. The property tax dimension of this crisis is the hidden layer that converts an insurance problem into an immediate cash flow crisis for existing homeowners. County governments have been aggressive in raising property tax assessments to capture the nominal appreciation in home values that occurred during the pandemic price surge. A homeowner in Maricopa County, Arizona, who saw their property assessment double between 2020 and 2023, is now paying tax on an appreciated value that no longer reflects what a buyer would pay in the current environment. But county governments do not reduce assessments quickly. They have budget commitments, bond obligations, and pension liabilities that depend on stable tax revenue. This means that even as the insurance crisis suppresses buyer demand and actual transaction prices begin to fall, property tax bills continue to reflect peak valuations. The homeowner is therefore caught in a triple compression: insurance premiums that have doubled or tripled, property taxes based on inflated peak assessments, and a mortgage payment set against an asset that is repricing downward. This is not a theoretical stress scenario. It is the current financial position of hundreds of thousands of homeowners across the Sunbelt markets that were the hottest real estate destinations of the last 5 years. The investor class that poured capital into single-family rentals during the low interest rate era is now confronting this same compression from the landlord's perspective. Institutional buyers, including Invitation Homes, American Homes 4 Rent, and numerous smaller private equity vehicles, purchased tens of thousands of homes across Florida, Texas, and Georgia between 2020 and 2022, underwriting their returns on assumptions about rent growth, insurance costs, and exit cap rates that are no longer valid. Insurance costs for large institutional portfolios in high-risk geographies have increased at rates that range from 40% to over 100% annually in some markets. These cost increases do not simply reduce margins. They alter the fundamental underwriting math that justified the original acquisition price. When an institutional landlord's operating expense model is disrupted by an insurance cost increase that was not projected, they face a choice between absorbing the loss or passing it through to tenants. In markets where tenants are already stretched to affordability limits, rent increases to cover insurance are not viable without triggering elevated vacancy rates. The result is asset-level distress in portfolios that were acquired at peak prices with leverage that assumed a specific cost structure that no longer exists. Blackstone's Fundamental Partners Fund and similar vehicles have already begun to experience elevated redemption pressure as institutional investors reassess their real estate allocation given the changing risk profile of these geographies. The commercial real estate sector, which is simultaneously dealing with the office vacancy crisis driven by the remote work shift, is now absorbing an additional insurance-driven impairment layer in certain markets. Industrial warehouses and multifamily complexes in hurricane-exposed coastal markets have seen their insurance costs become a meaningful drag on net operating income. Cap rate expansion, meaning lower property values relative to income, is already occurring in insurance-stressed markets independent of the interest rate environment. The combination of the two creates a dual compression on valuations that is more severe than either factor alone. A multifamily property in Miami or Fort Lauderdale that was valued at a 4.5 cap rate in 2021 might be repricing to a 7 or 8 cap rate today to reflect both higher financing costs and the insurance burden now embedded in its operating expense structure. That repricing represents a value decline of 35 to 45% in many cases. The regional banks that lent against these assets at 2021 valuations now hold loans where the loan-to-value ratio has crossed above 100%, meaning the collateral is worth less than the debt it secures. This is the definition of an impaired loan and the accounting reality that extend and pretend strategies are designed to delay. The migration data provides an early but unmistakable signal of how this is reshaping population flows. The United States Census Bureau reported that outmigration from Miami-Dade County accelerated in 2023 and continued into 2024. Florida overall, which had been one of the fastest growing states in the country, saw its net domestic migration slow meaningfully as insurance costs became a prominent feature of the relocation decision calculus. Surveys conducted by relocation services firms show that insurance cost has moved from a minor consideration to a primary factor in destination selection for households considering moves to the Sunbelt. This behavioral shift has real consequences for housing demand. The appreciation cycle in Florida and Texas was partially driven by net migration inflows from higher-cost coastal markets. If those inflows decelerate because incoming households are deterred by insurance costs, the demand foundation that supported price appreciation weakens structurally, and weakening demand in markets where supply has been expanding aggressively creates the conditions for price correction. The municipal bond market is the final systemic linkage that connects the insurance crisis to a broader financial contagion risk. Cities and counties in insurance-stressed markets finance their infrastructure through bond issuance. Those bonds are underwritten by rating agencies based on the economic strength and fiscal health of the municipality. If population outflows accelerate, if property values decline, and if the local tax base erodes, the credit quality of municipal bonds in affected markets deteriorates. We have already seen credit watch actions from Moody's on several Florida municipalities tied to insurance market instability and fiscal stress. A municipal bond downgrade in an insurance-stressed county raises borrowing costs for the local government, forces cuts to services, reduces the attractiveness of the area for new residents and businesses, and accelerates the very outflows that cause the downgrade. This is the doom loop operating at the civic infrastructure level, and it has a documented historical precedent. Detroit's fiscal collapse was driven by exactly this mechanism, the self-reinforcing interaction between population loss, tax base erosion, and rising borrowing costs. The scale and geographic distribution of the current insurance crisis means that multiple municipalities could enter this dynamic simultaneously rather than sequentially. The federal government's role in this crisis is both large and deeply constrained. The National Flood Insurance Program, NFIP, currently carries a debt of approximately $20 billion owed to the United States Treasury, accumulated from major loss events including Hurricane Katrina, Superstorm Sandy, and Hurricanes Harvey and Irma. Congress has repeatedly passed short-term reauthorizations of the NFIP rather than addressing its structural insolvency, because the political cost of raising flood insurance premiums to actuarially sound levels falls heavily on coastal communities represented by members of both parties. Risk Rating 2.0, the NFIP's attempt to implement more accurate pricing of flood risk, has already been partially rolled back under political pressure from coastal states, after the premium increases it prescribed were deemed unacceptable by homeowners who had purchased properties based on the assumption of subsidized flood insurance. This political intervention in the actuarial reality of flood risk is precisely how the problem compounds. Every year of subsidized insurance is a year in which malinvestment in flood-exposed real estate continues, the gap between subsidized premiums and true risk expands, and the eventual fiscal reckoning grows larger. The NFIP's structural deficit means that the federal government is effectively backstopping hundreds of billions of dollars in flood insurance liability using borrowed money, creating a contingent liability on the national balance sheet that does not appear in the deficit headline. The mortgage-backed securities market, which is the mechanism that allows the banking system to distribute the risk of individual mortgages across global capital markets, has not yet fully priced the insurance transition risk embedded in the underlying collateral. Mortgage-backed securities are rated and priced based on models that incorporate default probability, geographic diversification, and property value assumptions. Those models are beginning to be updated to incorporate climate-related risk factors, but the adjustment has been slow, partial, and contested by industry participants who face economic incentives to delay the repricing. An independent analysis published by the Federal Reserve Bank of San Francisco in 2023 estimated that homes in high flood risk zones that are not in currently mapped FEMA floodplains are overvalued by an average of approximately 11% relative to comparable homes in lower risk areas once unpriced flood risk is incorporated. If that overvaluation is present in the collateral underlying mortgage-backed securities, it represents a systemic mispricing of risk distributed across the global fixed income market. The recognition of that mispricing, when it comes, will move through the market not gradually but in discrete repricing events triggered by visible loss incidents, carrier withdrawals, or regulatory disclosures. The process now unfolding in the American real estate market does not have a simple policy resolution. The insurance industry's retreat is not a decision that a federal mandate can reverse. Carriers are making actuarial judgments about the relationship between risk and return, and no amount of political pressure changes the physical reality underlying those judgments. If the expected loss frequency and severity in a given geography exceeds what the regulatory rate structure allows carriers to charge, carriers will exit. They have fiduciary obligations to shareholders and policyholders that supersede any obligation to remain in unprofitable markets. The state-run fallback options, the FAIR plans, and citizens' equivalents are accumulating exposure at a rate that increasingly outpaces their reserve capacity. At some point, a major loss event will trigger a claim volume against these state-backed entities that exceeds their ability to pay, requiring either a state fiscal intervention, a federal bailout, or a policyholder payment default. None of those outcomes leaves the real estate market undisturbed. What we are watching is the beginning of a geographic repricing of American real estate based on the actual unsubsidized cost of risk. For decades, federal flood insurance subsidies, state-regulated premium suppression, and a reinsurance market that absorbed catastrophic losses at relatively low cost allowed real estate in high-risk geographies to be priced as though the risk did not exist. The infrastructure of subsidy and capital that supported that pricing is now withdrawing. The repricing it triggers will not be uniform or instantaneous. It will move market by market, property type by property type, and insurer by insurer. But the direction is not in question. The assets at the frontier of this transition, the coastal condominiums in Florida, the hillside homes in California, the bayou-adjacent properties in Louisiana, are already repricing. The question is how far the boundary of the uninsurable zone extends and how quickly it moves inland. For the mortgage market, the banking system, and the institutional investors who allocated capital based on a risk profile that is being revised in real time, the insurance transition represents an unacknowledged impairment of enormous scale. The extend and pretend dynamic in commercial real estate is already masking hundreds of billions of dollars in unrealized losses. The insurance crisis now introduces a second, overlapping layer of hidden impairment in the residential market that is at least as large and potentially more politically difficult to address because it involves the primary residences of middle-class Americans rather than the speculative holdings of institutional investors. The Federal Reserve and the FDIC have begun acknowledging the intersection of climate risk and financial stability in their research publications, but the regulatory frameworks governing bank capital adequacy have not yet incorporated insurance availability as a systematic risk factor in mortgage collateral valuation. This gap between the physical reality of the insurance market and the accounting reality of the banking system is the source of the next recognition event. When it closes, it will not close gradually. It will close in the way that all mispriced risks eventually close, quickly, visibly, and with consequences that were visible in the data long before anyone in authority was willing to describe them publicly. The data was there in the carrier withdrawal notices. It was there in the citizens' enrollment figures. It was there in the Louisiana insolvency proceedings. It was there in the NFIP's balance sheet. It was there in the First Street Foundation's risk models and the Federal Reserve's own climate research. The American real estate market is not uninsurable because of a sudden shock. It is uninsurable in a growing and definable geography because decades of mispriced risk are now being corrected simultaneously by the one part of the financial system that does not have the option to extend and pretend. Insurance companies cannot defer their losses to a future accounting period. When the hurricane hits, the losses are recognized immediately. That immediacy is what makes the insurance transition the most honest and therefore most destabilizing force currently operating in American real estate. The market can ignore interest rates for a quarter. It can ignore vacancy statistics for a year. It cannot ignore the letter from the carrier saying your policy will not be renewed. That letter is already arriving in millions of mailboxes. The sequence it triggers has already begun. And the financial architecture built on the assumption that it would never arrive has no prepared response for what comes next. If you found this analysis useful, follow along. There is considerably more of this sequence yet to unfold.